This week, big tech didn't scare the market with bad earnings. They scared the market with big spending. Amazon, Google, Microsoft, Meta. The theme was the same: CapEx is exploding. So the question isn't, is AI real? The question is, will AI returns arrive fast enough to justify the bill? Wall Street is sending a simple message: spend big on AI, but show me the payoff. This week, Reuters summarized it as big tech projecting over $630 billion in combined AI-related spending for the year, with investor concern rising because returns aren't growing at the same pace. That shift from asset-light software economics to capital-heavy infrastructure economics is the emotional center of this market. It means more risk and less margin for error. Let's break down the week's big facts. Amazon was the headline hammer. Amazon projected roughly $200 billion in CapEx for 2026, a huge jump from $131 billion in 2025, and they guided first-quarter operating income to be between $16.5 and $21.5 billion, which was below what analysts were expecting. The market didn't just hear investment. It heard near-term cash flow pressure and higher execution risk. Next up, Google. Google's operating data actually looked strong. Reuters reported fourth-quarter revenue of $113.83 billion and an adjusted EPS of $2.82. Cloud growth led the pack at 48%, beating both Azure and Azure. But Alphabet also guided its 2026 CapEx to be between $175 and $185 billion. So the market reaction wasn't Google is weak. It was, how long until this spending turns into profit? Microsoft's report became the template for this whole debate. Reuters reported Azure revenue growth at 39% for the quarter, which was just barely above expectations. Microsoft also ramped up CapEx, with Reuters highlighting investor focus on AI spending and slower growth. In fact, Microsoft guided Azure growth to be around 37 to 38% next quarter, a slight slowdown. The translation is, the business is strong, but the market is now measuring the timing of its return on investment much more harshly. And then there was Meta. Meta was the exception, emotionally, because it showed how it's funding this spending. Reuters noted that Meta raised its 2026 CapEx guidance to between $115 and $135 billion, a big increase tied to its superintelligence push. But Reuters also reported that fourth-quarter ad revenue was up 24% to $58.14 billion, which helps fund that spending. The market can tolerate big spending better when it sees the cash flow that's powering it. Now let's talk about the second-order impact. When big tech signals massive CapEx, the market does two things at once. First, it worries about margins and free cash flow at the big cloud providers, the hyperscalers. Second, it reprices the entire ecosystem software and semiconductors based on a new, lower appetite for risk. Reuters described a brutal software Mageddon. The S&P Software and Services Index shed about $1 trillion in value. Since January 28th, the ripple effect was huge. So here's the honest framing. Are we at a top, or is this just a repricing? This week didn't prove AI is a bubble. It proved AI is getting expensive. And markets are now asking, is this spending building a moat, or just building a massive bill? Reuters even compared investor fears to the dot-com era, worrying about a heavy infrastructure overbuild without guaranteed returns. So, is it a top? Not automatically. But it is a regime shift. The market is paying less for promises and demanding more proof of payback. What would Charlie Munger say about the AI spending spree we're seeing right now? If the legendary investor were here, he wouldn't start with predictions. He'd start with incentives and economics. He would ask three simple questions. Who can fund this massive spend without stress? Who has a clear path to monetization? And who gets hurt if the payoff takes longer than expected? You see, in a capital-heavy moment like this, the most dangerous companies are those that need everything to go perfectly. I'm talking about companies with a high valuation, weak cash generation, and a massive spending plan. When the market gets nervous, these are the first to get hit. And this week, the market got very nervous about CapEx. So what should you do? This isn't personalized financial advice, but let's walk through a playbook based on this week's data and typical market behavior. First, what should you consider avoiding or reducing in the next 1 to 2 weeks to manage risk? In what we can call a CapEx fear market, High multiple software stocks that are most exposed to AI disruption narratives tend to get punished. These are the very companies Reuters was talking about in the recent software rout. Also, be wary of those crowded high beta AI trades that can gap down hard on a simple shift in sentiment. And most importantly, avoid oversized positions that force you into making emotional decisions. The key here is to sidestep the dangerous combination of crowded trades, high volatility, and weak cash flow. That's the trifecta of pain when the market pulls back. So, where might the odds improve? Where can you look for opportunities? First, look for the cash-funded spenders, especially if their valuation becomes reasonable. Think about a company like Meta. Its advertising business is a cash machine, funding its massive CapEx in AI and the metaverse. Or consider Google, with its incredibly strong operating results and leadership in cloud growth. Their spending is backed by real, substantial profits. Next, consider quality compounders that were sold off simply for narrative reasons, not because their business fundamentals changed. Microsoft could fit in this category if you believe its Azure and enterprise moat will remain durable over the long term. But you have to be willing to accept the short-term volatility that comes with it. And finally, you have the picks and shovels plays. This is a classic strategy. When the hyperscalers are spending billions on building out their AI infrastructure, their suppliers are the ones who tend to benefit over time. This includes big names like NVIDIA and AMD. Or you could get broader exposure to the semiconductor industry through an ETF like SOXX. But even these safer plays can swing violently in the short term, so your position sizing is absolutely critical. Don't go all in at once. For the next couple of weeks, it's probably wise to treat the market with extra caution. Here's a simple 3-step approach. Step 1. Assume volatility is the new normal. Expect big price swings, gaps up, gaps down, and sharp reversals to continue while the market digests all this new spending guidance from the tech giants. The dust hasn't settled yet. Step 2. Consider 3-tranche entries. This is a disciplined way to build a position. If you see a company you like and want to get exposure, you could buy 1/3 now. Wait for another down day to buy the second third, and only add the final third after the market shows real signs of stabilization and a clear upward trend. This prevents you from catching a falling knife with your entire position. And step 3. Watch a simple money flow dashboard. You don't need a complex system. Keep an eye on the QQQ as a proxy for tech risk appetite. Watch the SOXX ETF to understand the health of the AI supply chain. And most importantly, listen very closely to what analysts are saying about ROI timelines during company earnings calls. Are they talking about returns in 1 year or 5? That timeline is what the market is obsessing over right now. Now, let's talk about the part that most people watching this probably need to hear. What if you're already holding these stocks and you bought them at higher prices? You're sitting on a loss and feeling the pressure. Should you stick with it or switch to something else? The most important thing is not to switch just to feel a moment of relief. Switching from one great company that is down to another company that is up often just locks in your losses while you end up buying someone else's strength at a high. Instead, focus on resizing first. If a position is causing you stress and keeping you up at night, it's too big for your risk tolerance, regardless of how great the company is. Reduce it to a size where you can think clearly again. Second, learn to separate the business from the stock's multiple. This week, the market punished stock multiples and spending narratives far more than it proved that the underlying businesses are broken. A great business can have a volatile stock price. Don't confuse the two. And third, if you absolutely must rotate out of a position, make sure you are upgrading the quality of your portfolio, not just soothing your emotions. This means moving from companies with weak cash flow and a lot of hype to those with strong cash flow, fully funded CapEx plans, and a much clearer path to payback. Profiles like Meta or Google, which we discussed earlier, fit this description. Charlie Munger's real edge was never about forecasting the future. It was about temperament. It was about staying rational when everyone else was panicking. The story of this week is actually quite simple. AI is real. The massive spending on it is real. And now, the market is demanding to see the returns on that investment. So stay calm. Avoid making obvious, emotionally driven mistakes. If you're buying, scale your entries slowly. And let the loud, frantic traders trade with each other. In the long run, calm beats chaos, and real payback always beats hype. Thanks for watching. If you found this helpful, be sure to subscribe for more insights to help you navigate these markets.